Hello, everyone, and thanks for joining me for this webinar on the ACH Rules, a review and update. You know, in 2011, the Automated Clearinghouse completed over 20 billion transactions with a total dollar value of almost $34 trillion. That's 34 with 12 zeros after it. And the volume promises to continue to grow. So NACHA and the regional ACH groups are really trying to develop more ways in which the ACH can offload some of the traditional check volume and basically continue to grow so that they can continue to serve the American public and the American business people and American banks with transaction capabilities that have been proven since the first ACH transactions started crawling out from Social Security Administration back in the 1970s or so. Today we're going to talk about some of the significant NACHA rules. Some of them are rules that have been around for a while and that sometimes cause trouble with banks. That is, they're confusing, they can be difficult sometimes, and they can cause losses for banks. And we're hoping to be able to understand them a little better by the time we're done. We're also going to cover several changes in the rules that have come about recently or will be coming about during the balance of the next, say, 12 months, based on releases from NACHA that we've received already. So without further ado, let's get started. And if you take a quick look on pages 2 and 3 of your handout, there's a list of terms there, most of which I expect that you understand since you're involved in automated clearinghouse work already, and I won't bother to go through them in any detail. They're here for your reference at a later point. The one thing I do want to point out is the term receiver, however. Note that the receiver is a consumer or an organization that has authorized an originator to initiate an ACH entry to the receiver's account with the RDFI. Now, the only reason I emphasize that particular definition is because it will come up a few times during our discussion of some of the check conversion entries that banks have to deal with from time to time. And as we will see how those work out when we get to them. Over on pages 4 and 5 of your handouts, there are a couple of little graphics that sort of illustrate the way that transaction information and transaction funds flow work with respect to checks and with ACH transactions. So that, for instance, on top of page 4, you see a diagram that's supposed to illustrate that check payment information starts with the depository bank where the check is deposited. It goes through the clearinghouse or the Fed and ultimately ends up at the paying bank, and the paying bank loses the funds back to the depository bank. So the information flows to the right in our diagram and the funds flow to the left. ACH debit entries are similar in that the transaction information moves from the originator on the left of the diagram to the receiver on the right-hand end of the diagram, but the funds move from the receiver's account to the originator's account in the opposite direction. And it's actually the same. It's built on the same paradigm as check payments. Credit entries, on the other hand, are different. Credit entries are something that the check paradigm doesn't handle. So credit entries actually move funds and information in the same direction from the originator to the receiver. One other point here on page 5 is that when we're talking about ACH transactions, we're talking about originators and receivers. Note that if a transaction starts with originator A and ends up with receiver B, if that transaction gets sent back, it goes back through, and the originator is the party that receives the reversal, so that the roles don't get reversed just because the direction of the transaction gets reversed when there is in fact a reversal. let's take a quick, talking about check conversions earlier, I'm going to focus the next few minutes on a discussion of some of the conversion entries that are possible through the automated clearinghouse and just kind of hit on some of the high points that banks are running into and that I see coming up as questions in BOL bankers' threads from time to time. On page 6, there's a discussion of an eligible source document. Back in a couple of years ago, the NACHA revised its operating rules and guidelines and completely overhauled them and put them in different order and so forth. And prior to that point, there was a section for each of the transaction types that were check conversions that basically laid out the qualifications for what's called an eligible source document for the ARC, and another series of definitions for eligible source documents for the BOC or back office conversion, and so forth. Now they have a single set of criteria that define an eligible source document that can be used for an ARC, which is an account receivable conversion, or BOC, which is a back office conversion, or POP, which is a point of purchase entry, all of which have their origins in a paper check, but in every case, these transactions only gather the data from the check and actually send an ACH transaction that's built on that data. So I'm not going to go through all 13 elements of the eligible source document qualifications, but I do want to hit on a few of them just to point them out. The first one is that it has to have a pre-printed serial number. It's important that the serial number be in the microline, although in theory, if there's a pre-printed serial number on the check and it's not in the microline, it could be added during the edit process by the originator. But it does have to have a pre-printed serial number, and it has to be for $25,000 or less. Well, the vast majority of checks in this country are, in fact, for less than $25,000, so that's not a big hurdle to cross. One of the key elements here is item number 3 on the list, is that it has to be completed and signed by the receiver, except for POP entries. For a POP entry, the receiver hands basically a blank check to the cashier. The cashier voids the check and gathers the information from the check and hands the check back. Now, the signature requirement then means that it has to be signed by the receiver, means that this cannot be a third-party check, because let's say a paycheck, the issuer of the paycheck is not there to provide the authorization, and would be the receiver, and the receiver isn't giving an authorization there. So item number 3 is critical. Item number 5 is critical. It can't have an auxiliary on us field. An auxiliary on us field is the series of digits that are to the left of the routing number on a check that is one of the business-size checks, the longer checks. It does not appear on a so-called personal-size check because there just isn't room. And in the auxiliary on us field is where you typically find the serial number for a business check. So if the check has an auxiliary on us field in that microline, it's not eligible for check conversion under the ARC, BOC, or POP entry definitions. And that can be helpful to you if you're running into some problems. It also is designed, let's face it, it's designed to prevent the vast majority of business-style checks from being used in check conversions, and that is by design, I would add. However, if a business has a personal-sized check that it uses, and there are some businesses that use personal-sized checks, personal width checks anyhow, those could go through those would hit that qualification without a problem. It can't be payable to a person other than the originator in item number 6, and that's another clue that it cannot be something like a payroll check that's being converted. It can't be a check provided by a lender for purposes of accessing a credit card account, home equity line, or other form of credit, which is item number 8. And that, it disqualifies the item for an ARC, BOC, or POP entry. On the other hand, it's a good time to point out the fact